Welcome to Iron Financial. We're the place you come to forge stronger portfolios because we stress test companies' foundations, we cut through the hype, and we focus on one thing: structural integrity. Today, we're putting Namib Minerals, ticker NAMM, into the forge. Now, they're a gold miner, and they have a story that just looks, well, it looks way too good to be true. And you know what that usually means. It's our job to find out if we're looking at solid gold here, or if it's just fool's gold with a shiny new coat of paint. All right, let's get to work. Okay, so this is the number. This is the one that just stopped us dead in our tracks. For the full year 2025, Namib Minerals went on the record reporting a net profit of $101.2 million. Let that sink in. Now, you got to put that in context. For a junior miner with operations mostly in Zimbabwe, that is an absolutely spectacular headline-grabbing number. I mean, on the surface, it looks like a machine that is just printing money. But at Iron Financial, we always dig deeper. Whoa, hold on a second. Let's just pump the brakes right there. A profit of over $100 million on total revenue of just $82 million? I mean, how is that even possible? My kid's lemonade stand has better margins than that. Basic business math, the stuff you learn on day one, tells you profit cannot be more than your total sales. This isn't just a red flag. This is a full-blown 5-alarm fire. It absolutely screams financial engineering, not operational excellence. And you know what? This is the central mystery we have to solve today. So here's our blueprint for the day. First, we're going to dissect that headline profit, figure out if it's just a mirage. Second, we're digging into the real operational numbers, what's actually happening at the mine. Third, we're going to weigh all the heavy risks that are cracking the balance sheet. And finally, we'll deliver our verdict. Is this a stock you forge, or is it one you fold? All right, let's get right to it. Section 1, a miner's mirage. You know, whenever we see numbers this shiny, this perfect, it's almost always because they're hiding something brittle right underneath the surface. And it's our job to take a hammer to it and see exactly what we find. Let's start deconstructing that unbelievable $101.2 million profit. Look, we're showing you this again because it really is the heart of the entire issue. It's a profit figure that literally defies financial gravity. This is not the sign of a healthy, robust business. No way. It's the sign of a business that's playing games with a scorecard. So the big question is, how in the world do they pull this off? Well, the answer isn't in the mine. The answer, just as we suspected, has absolutely nothing to do with pulling more gold out of the ground. The real key here is buried deep in the accounting footnotes, the place most people never look. This profit, it's not cash. It's the result of massive, one-time non-cash items that are all related to the company's public listing through a SPAC. And you know, a SPAC is just a special purpose acquisition company. It's basically a backdoor way to get onto the stock market without all the usual scrutiny. And this is exactly how they built their house of mirrors. So first, they booked a paper gain, a non-cash gain of $164.5 million. Now, most of that came from revaluing something called earnout liabilities. In plain English, these are just future potential payments that they now suddenly don't expect to have to make. So let me get this straight. You're telling me they just decided they probably won't have a future cost, so they erased it and called that profit today? That's not money coming into the business. It's just an accounting entry. That's exactly right. Then you subtract their big one-time listing expenses. So a giant paper gain minus a giant paper expense created this absolute fantasy of a headline profit. All right, I've had enough of the accounting gymnastics. Seriously, I want to know what's really going on in this business. Forget the paper gains. Agreed. It's time to get our hands dirty. It's time to assess the real foundation of this company, the mine itself. Is it getting stronger or is it getting weaker? Is it producing more gold or less? Let's dig into the real operational numbers. Now this table tells the real story. In 2025, gold production completely fell off a cliff. It went from over 37,000 ounces down to just 25,000. That's a drop of about 33%. So revenue, predictably, also fell. But wait, here's another one of those strange numbers. Adjusted EBITDA. That's a measure of profitability that management really wants you to focus on. It actually went up by 18%. How on earth does production collapse while a key profit metric goes up? The answer, my friend, is in that very last line. Oh yeah, that last line right there, that's the kill shot. The C1 cost per ounce, which is a core measure of how efficient a mine is, it's skyrocketed by nearly 44%. It went from $1,150 an ounce to over $1,650. They are spending dramatically more money to get less gold out of the ground. That is not a sign of a resilient business, it's a sign of decay at their main asset, the How mine.
Look, when you spread your fixed costs over fewer and fewer ounces of gold, that is a recipe for absolute disaster. This isn't just some small crack in the foundation, this is a major structural weakness.
And this slide just brilliantly illustrates the entire issue. Forget the headline profit of $101 million. That was the mirage. The reality, the hard truth, is found on the cash flow statement. For all of 2025, the entire business, the actual mine, generated just $13.8 million in cash from its operations. That is the real number, and that's the only number that really matters. That is the true measure of this company's underlying strength, and it is a tiny, tiny fraction of the profit they reported. You know, cash pays the bills, not accounting tricks. Okay, so the operations are generating very little actual cash, and they're becoming way less efficient. I mean, that's bad enough, but even if you could somehow get comfortable with that, the company's financial structure and the external environment they operate in, they present enormous risks. So now it's time to examine the cracks in the balance sheet and beyond. This is where a weak foundation can completely crumble under pressure. Yeah, this is a number that should make any serious investor just stop and take a very long pause. Negative $37.4 million in working capital. And what that actually means is that their short-term liabilities, the bills they have to pay very soon, are much greater than their short-term assets, like cash and inventory. This is a classic textbook sign of severe funding pressure. They are financially weak, and they are living on a shoestring. A company in this position has absolutely zero room for error. They are walking a tightrope without a net. So what do you do when you're in a financial bind like that? Well, you look to raise money. But you have to look at how they're doing it. They have filed to allow the resale of up to 87.5 million shares. Now that represents nearly 84% of all the shares that currently exist. Okay, so if those shares hit the open market, it creates a massive supply overhang that could absolutely crush the stock price for all the existing investors. But here's the really crucial point. If all the related warrants are exercised, it could generate up to $213 million, but that money doesn't go to the company. It doesn't strengthen NAMM's balance sheet. It goes directly to the selling security holders. It does literally nothing to fix their working capital problem. And do you remember that Celebi Trust we mentioned a minute ago? Well, they own about 63% of the company, and that makes Namib Minerals what's officially known as a controlled company. Now, this isn't just some technical term. It is a giant warning label for minority investors. It means the company is exempt from key Nasdaq governance rules, like having a majority of independent directors on the board. So when you invest in a company like this, you have less of a voice and you have fewer protections. The controlling shareholder is firmly, and I mean firmly, in the driver's seat. Okay, so let's just stack up all the risks here. Their entire operational focus is in Zimbabwe, a jurisdiction with a long history of hyperinflation and political instability. Number 2, they are completely dependent on a single, state-controlled entity to buy all of their gold. Number 3, they have massive capital needs to try and restart 2 other mines. And how much cash did they have on hand to navigate all of this? At the end of 2025, just $1.9 million. 1.9. That is not a war chest. That is pocket change. Okay, it is time to put it all together. We have torn down the accounting mirage. We have stress-tested the very weak operational reality. And we've illuminated all the heavy risks sitting right on the balance sheet and in their operating environment. So now, let's weigh all of that against management's supposed blueprint for the future to arrive at the final iron financial verdict. Is this a company you can forge a future with, or is it simply time to fold? All right, so this is the bull case. This is the story management is trying to sell you. They have a 3-step plan to try and build their way out of this very tough spot. First, they want to expand the milling capacity at their main asset, the How mine. Second, they plan to complete the dewatering process at the Redwing mine, which is a critical first step to getting it restarted. And third, and this is the biggest and most uncertain step of all, secure the massive amount of project funding needed to do all this. This is their blueprint for growth. And here's the beautiful future that this blueprint supposedly unlocks. Their 2026 guidance projects a pretty modest increase in gold production. Okay, but then look at that adjusted EBITDA, $50 to $62 million. That is a huge jump from where they are today. But this number is built on a foundation of pure hope. The only way they even get close to that number is by assuming a gold price of $4,500 an ounce. I mean, that is wildly, wildly optimistic. And even with that heroic gold price, their all-in sustaining costs are guided to be between $2,400 and $2,700 an ounce. Those are incredibly high costs. This guidance isn't a solid plan. It's a high-risk bet on a best-case scenario that may never, ever materialize. Now, to be fair, one potential positive is the new leadership.
Tulani Sequela was recently appointed CEO. He's a company veteran, and he's talking the right talk, right? He's talking about building a scalable, capital-efficient platform to create value. A strong leader with a clear vision can sometimes turn a shaky situation around. This is the narrative of renewed focus and disciplined strategy that the bulls out there are really clinging to right now.
But a blueprint is absolutely useless without a construction crew to build it. A vision is just words on a page without a team to execute it. And right now, this company is missing two of its most critical leaders. They are actively searching for a chief financial officer and a chief operating officer. You simply cannot execute a complex, high-stakes operational turnaround and secure intricate project financing in a very difficult jurisdiction without a CFO and a COO. The fact that these two chairs are empty is one of the biggest red flags of all. The leadership team is incomplete at the absolute worst possible time.
So the iron financial verdict is clear. The profit is an accounting mirage. The core operation is deteriorating. The balance sheet is dangerously weak. The company is a controlled entity operating in a high-risk jurisdiction with a turnaround plan that's based on a fantasy gold price and an incomplete management team. Our call? This is a fold. This isn't a foundation you can use for a long-term portfolio. It's a high-stakes lottery ticket. It's for speculators, not for serious builders. So we'll leave you with this one final question to think about. Management has a blueprint on paper, sure, but we've just shown you the deep and very dangerous cracks running through this company's entire foundation. Is that blueprint really strong enough to bridge those gaps? Or is it just a piece of paper that's going to get torn apart when the real-world pressures start to mount? Before you even think about buying into this story, you need to have a very good answer to that question. That's our analysis. Stay sharp and keep forging your portfolios.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before